Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Thanks for tuning in to this week's episode of the Major League Real Estate Podcast. Today, we're joined by Barrett Linburg, live at the 2025 Tax, Legal, and Wealth Summit. Barrett is a co-founding principal of Savoy and oversees the capitalization and structuring of the company's investments and deal sourcing. Barrett started investing in real estate in 2012 and enjoys learning about esoteric strategies which he implements to create excellent risk-adjusted return. He specializes in transactions with complex structures such as historic tax credits, opportunity zones, low-income restrictions, as well as the deconversion of fractured condos. Barrett, so glad to have you on today. You are the QOZ guy, QOF guy in this, in the nation, probably. Honestly, it's probably top 5 when it comes to knowledge and just being able to break it down for everybody. So excited to have you on today and just talk through QOFs, QOZs, and what you did, honestly, just what you've done. So would love to hear a little bit more of your background, how you got started in QOZs and QOFs. And yeah, we just would love to start there.
Yeah, awesome. Well, thank you for having me on. So much of the opportunity zone knowledge has just come by being a practitioner and doing it day to day, because so many things in real estate, whether it's historic tax credits or low-income housing tax credits, which we don't do, but so many of these things have years or decades of practice behind it. So you can go to firms that have been built around these practice areas and ask them, well, what does the case law say, right? What did the IRS say when they prosecuted people for doing it the wrong way? But with opportunity zone, that doesn't exist. It's only been around for 7 years. The IRS hasn't issued that much guidance. There just isn't that much about it. And so really there's practitioners who are capitalizing deals, who are out there raising money, and you're basically consulting with the best minds in the CPA world and the best tax attorneys and the best real estate deal attorneys. And you're putting all that together to go do your next deal. And you're trying to figure out what's the spirit of the law, what's the letter of the law, how do I make sure that in our case, when we're dealing with tens or hundreds of millions of dollars of other people's money, how do I make sure that we are clearly on the right side of the line so that if any of this does ever end up in tax court someday, we know that we're in the right. So a lot of it is just that. We've been doing it now for 5 years. We did our first project in 2020, and we just constantly are iterating on how we did our first deal.
Yeah, that's all. It's a great point you mentioned. Is that there's only 2 items really that came out of Tax Cuts and Jobs Act that we still don't have any tax court guidance on, and that's just happens to be QOZs and 199A deduction. I think we actually got a court case just a day ago or so, kind of related to it, but not really. But yeah, it's we're playing in no man's land whenever we're dealing with QOZs. We're just always looking for guidance, trying to sort through what might the intention have been, what did Congress ultimately want, right? Actually, I'll take 2 steps back. Is so your first deal with the QOFs, did you intentionally go after that? Did you want to go after the tax benefits at the first target, or did that just happen? Did you just fall into it?
Yeah. So stepping back, I've been in, and Pat, thank you for the nice introduction. So we've owned and operated real estate since 2012. We started by buying a beat up 8-unit deal and renovated it. And since then, we've bought and sold about 30 properties and currently own about 30 properties. But we were just going about business as usual. We found some neat 1960s properties in an area of town that we liked, thought it was in the path of growth, and said, hey, we're going to buy these old beat up buildings and fix them up. We think that that's good business, fits with what we've always done, and will make a good return for our investors. And went to our real estate deal attorney and said, hey, here's our business plan. Help us start setting up entities and get ready for the acquisition. And he said, hey, these are in an opportunity zone. And we said, well, what's that? We didn't know how to spell OZ. And so he informed us, and luckily he was in a working group of attorneys who knew it, and they've been talking about best practices. So we got a crash course on OZ in 2020. And even more fortunate, our CPA was in a similar group and had started setting up OZ funds for some of their clients. And so we just happened to be very fortunate that our two main key people, the CPA and the attorney, were early adopters and understood this stuff and were able to teach us. And so we bought a portfolio of 8 properties in an opportunity zone census tract and got that knowledge and had investors that had been with us forever who happened to have capital gains. It was 2020. There was a lot of money flying around. And so that worked out well for us. So that's how we learned and did our first deal. And it's been this way since, right? The deal first, the returns made sense. It's the business type that we'd always done. For us, it's Texas apartments. And the returns were there. And now the OZ tax benefits get to add an additional layer of good stuff.
Yeah, no, that's fantastic. I mean, that's that's first off, always most important, right? We always want to focus on the returns because everything makes sense from a business perspective. And then how do we get the cherry on top from a tax perspective too? And thankfully, QOZ is one of the most powerful hacks out there when it comes to it. That sounds, so that's so interesting because specifically from a business perspective, QOZs are structured, which we'll get into in a second, are specifically structured to kind of be more for long-term investors, which sounds like for Savoy fits perfectly in what you guys have been doing previously. Do you want to tell us a little bit more about that too?
Yeah. So my business partner and I have been set up all along to do apartment deals. And I was a mortgage broker. My business partner was a property manager. And we'd gone on along about that for a long time. And we would just kind of find a deal that we liked and we would do it. We've been a lot more intentional about that over the past few years and explicitly now vertically integrating with not only property management, but also with asset management, construction management, and investor relations. So we've set up companies to handle all that because now we know, hey, we own 25 deals that have been capitalized in the OZ structure, and we're going to own those for 10 years. These investors now over $100 million in opportunity zone equity, we're going to have all these investors for 10 years. So we need to know that we can really be good stewards of capital, be stewards of these assets, be good property managers for these tenants, all these things for a long time. So we want to control all the pieces. So that's how we've set up our company for success.
Oh, that makes a lot of sense from business perspective. Yeah, that have everything in house, right? It's normally a lot of times syndications, it's hey, it's a 5-year cycle, right? 5 to 7 year cycle, everyone gets out. But with OZs, it's 10, maybe 30-year hold, right? Nowadays, with the new, well, it's not with those, but with the new ones, right? That's a lot there. So that's awesome. That's really cool that you guys have kind of really leaned into a different, and honestly, I was thinking about this too. I listened to one of your other podcasts that you had a couple weeks ago. Is that what I really love, especially about how you're doing your setups, especially with this, is that you're so focused on the local, right? And so that's what QOZs are set up to do, is to create investment locally and have local investors, local project managers, local management, right? Just focus on incentivize these areas that are going to, guess what? They wind up benefiting the community and focusing on that. And so I think that's really, really amazing, actually. It's cool seeing it play out in real time, the intent that Congress had and watching it happen, right? It's it doesn't always happen, unfortunately. I know there's some other deals that didn't go as well as you guys have, but I think it's probably one of the keys to the success for you guys is that you've had the hand on the wheel the entire time and you've wanted to pour back into the community. So I think that's awesome. So we've talked around a lot of OZs. We talked around a lot. And everyone's okay, what is a QOZ, right? What is a QOZ? What is a QOF? What are these terms that we're throwing out there? It's always everybody wants to know after a certain point.
Yeah, I think, right, we jumped ahead, right? So now let's go back. So Opportunity Zone tax structure was created by Congress, part of Tax Cut and Jobs Act in 2017-18. And so it is a tax benefit created by Congress. They picked certain areas of the United States, and these are census tracts. There's 8,500 of them. They're all over the United States. And Congress basically said, hey, these are areas that we want more investment in. And in order to get more investment there, let's incentivize taxpayers to put more long-term patient investment in these areas. So how do we do that? Well, they said people have capital gains. Maybe they own stock that's appreciated that they're just not willing to invest other places. So let's incentivize them. Turns out people are selling businesses. Now they have crypto. They could sell art. There's all types of different capital gains that can be realized or are being realized every day. So let's incentivize those people to invest in these low income areas, and let's give them a few different tax benefits to do that. Number one, they get to defer the capital gain for a few years. OZ 1.0, it was a calendar date. They get to defer it until the end of 2026. In Opportunity Zone 2.0 now, it's going to be a rolling 5-year deferral. But the first benefit, which is the smallest one, is a deferral of their capital gain. The much larger benefit is, hey, they're making an investment in this area and they're not going to have to pay any capital gains tax on the appreciation of this new investment. And in real estate, they're not going to have to recapture any depreciation over the 10-year hold period, which I know you have a good real estate audience who understands the value of that last piece of the puzzle.
Yeah, no, it's right. And so like the 10-year hold is amazing, right? That's like so fantastic. And like it's funny that like the deferral of gains, the smallest piece, the smallest benefit that we can use. But people do deals all the time for that, right? With like 1031s, et cetera. But that's only the smallest portion of what you can get out of a QOZ investment. And so I think it's amazing. Like QOZs to me, it's interesting you mentioned 2020. That's when like you got into it. Honestly, I feel like that's when everyone started to realize the kind of benefit that it felt to me like 2018, 19, no one really understood QOZs or really understood how to take advantage of them. Probably just so fresh and so new. There wasn't a whole lot of regulation. We didn't get the regulations finalized from that until 2020. So it took some time for us to actually know when to do all of this. And so on that note, so like, what's a typical structure that you see from QOZs and QOFs? Like, what's the typical structure that you wind up seeing? I was like that's the most important piece of the puzzle, I think.
Yes, it's important to understand that there's two different entity structures that we deal with day in and day out. So number one is the Opportunity Zone Fund, and that's really where the money goes. And then number two is the Opportunity Zone Business. And don't let the naming of these fool you. It's not a business like a donut shop. It's just called an Opportunity Zone Business because that's what the legislation, the code calls it. So the Opportunity Zone Fund is where the money goes, and the Opportunity Zone Business is where the real estate is held. And so those two types of entities are what we deal with day in and day out. And so first, the money comes into the Opportunity Zone Fund, and then the fund invests into the Opportunity Zone Business or the real estate. So in my day-to-day world, every piece of real estate that we develop or renovate is owned by a single purpose entity, which is a qualified Opportunity Zone business. And then that QOZB might have multiple Opportunity Zone Fund investors. So Nate Sosa's Opportunity Zone Fund and Barrett Linburg Opportunity Zone Fund might both be investors in one real estate deal called a QOZB.
Right. That's like the important piece that like whenever everybody goes, oh, hey, I can set up my own QOF, right? I'm like, yeah, yes, you can. I wouldn't recommend doing that, right? And we get private letter rulings coming out basically every single week at this point where someone has messed up the election piece, right? They haven't filed the proper 8996 or 8997. Those are the tax forms associated with it. Right. It's like, oh, someone forgot. Someone thought the attorney was doing it and someone thought the CPA was doing it. And turns out someone thought the investor was doing it. Turns out nobody did it. Though it's important little paperwork items that need to be had because there's a lot of complexity to that.
Yeah, I'll say that I mentioned, in 2020, our attorney and CPA were very smart and very early adopters to this stuff. And I feel like they really nailed it 5 years ago on telling us how to set up. So our Opportunity Zone business is all in the real estate, and we take investment from a lot of different OZ funds. Yeah. So a lot of our clients actually have set up their own OZ funds. We have a lot of families that set up their own OZ funds, and we act as the real estate deal source for them. Luckily, they have good advice from CPAs and attorneys, so they are making their elections correctly. What we do is our QOZB entities are sending out really detailed K1s. So our K1 then has 5, 6, 7, 8 pages of notes behind it. Here's your tax basis. It's 0, right? Which is a weird quirk of OZ. But here's your book basis. And then, it just goes down all these different things. That way they can hand our K1 to their CPA, and it makes it a heck of a lot easier for their CPA to fill out the OZ funds 8996 and then their personal 8997. So it all iterates. Yes, it's complicated. We don't really recommend investors set up their own OZ fund unless it's kind of $1 million plus gain that they want to do in the OZ structure. But it's certainly a possibility.
You guys have your own QOF that people can invest in, but it sounds like you also will take other investments from other existing smaller QOFs as well.
That's something that's unique to our firm. I don't know a lot of other groups that do that, but we've been set up like that since 2020, our first project.
That's super interesting. I actually didn't know that. That's really, really intriguing, actually. Because, that's one of the keys that you need. You need to have that two-tier structure entity. Absolutely. But if you are the lower tier, that allows other people to do other flexible things at the top with the QO, with their own QOFs even, or saying, hey, you can invest in ours, you can set up your own. That's super, super intriguing. I had not considered that. So I did not know that. So that's super awesome to know that now. Real estate syndication tax is confusing to you. Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. So when it comes to, I guess, you mentioned something that I actually wanted to ask about. So you talked about how you have zero basis, right? When you invest into a QOZ. Let's dive into that. Why is there zero basis there? Does that mean no one gets depreciation losses?
Yeah. So once you invest into an opportunity zone fund, you're investing, and you're going to know this better than me and probably explain it better than me. But because you're deferring the tax on that money, you don't get basis on your investment into the OZ fund. Am I explaining that right?
Yeah, you're basically correct. Yeah, you basically are putting in something that is zero essentially. And so, will you get? Can you gain basis over time? Yes, as the substantial improvements are made, if that's the case, or the construction's done, etc. Right, you can gain basis over time. But you're correct, right? Is that that's the best way to explain that?
Great. And so I can explain the way that we get our investors' basis.
Let's dive into that.
So we get our investors' basis through qualified non-recourse financing. And once they eventually pay their taxes, they get more basis. And so in general, we do it through qualified non-recourse financing for those OZ fund investors, and then you can depreciate against that. We have not had any problem getting them that qualified non-recourse financing to depreciate against, and we can't give them enough depreciation to be greater than the financing that we achieve.
Right, exactly. And that's, so there's some limitations there, but that's one of the beauties of QOZs, right? So hey, even if you don't get to take the losses today, they're limited or something like that from depreciation. Like Barrett said, when you have your gain realization, those get unlocked, and now you can use those against the gain that you've kicked down the can, deferred until April 15th, or you realize in 26, but then you pay the tax on April 15th, 2027 or later, potentially, at least has to be in that year. But that's, it's one of those other amazing hacks with QOZ investments in general. So that's awesome. So when you are actually evaluating which zones to invest in, what are you guys doing there? What, when you guys are looking and trying to decide that, what draws your eye to a certain area over a different one?
Yeah, let me be a little bit, I'm going to go even a further step back.
Yeah.
So, there's 8,500 of these census tracts throughout the country. A lot of people have this misconception that, hey, these are low-income areas, they're not worth investment. And that truly is a misconception. There's 8,500 of these, and today's map was based off of 2010 census data. It was chosen by governors in 2018 or 2017, and now it's 2025, right? So 2025, and it was based on data from 2010. A lot has changed in 15 years, especially in Texas, where there's been a ton of net immigration. And so what we're able to do in these markets that we know really well is look at the map and say, number one, which of these census tracts has changed a whole lot? Or which one do we feel like over a 10-year hold period is really likely to change because it's in the path of progress? And then for us specifically, where we focus a lot of investment in one area, we're not just doing one project. In one neighborhood in Dallas, we're now on our 24th project in a 1 mile radius.
Yeah, that's crazy.
So it's where can we affect change? So all those things put together, we kind of say, where do we think the best census tract is going to be if we're going to invest some serious capital? And so that's the thought process that we go through when we're making investment. We don't believe that if you just like wander into a desert and do one project that it's going to be successful. But if you go into an area that already has good things going on around it, and you're able to make a serious investment and maybe invest in several projects within that area, that all of a sudden you can control your own destiny. And that's kind of the path that we've taken.
I really like how you guys have structured that, right? And so like it's like finding the area that like you think, I like what you mentioned, the path of progress. I guess, how have you guys evaluated that? Like, I think you've written about that before as well. It's like, what is the path of progress, and how do you guys kind of like figure out, hey, I think this area is going to start to grow from a perspective. Yeah, I would love, like, what are your thoughts on that?
Yeah, part of it is just gut feel, right? So I mentioned that we're based in Texas. We've always been based in Texas. We're in Dallas. We've always been based in Dallas. So part of that is just 20 years of real estate experience and saying, hey, I know that there's more restaurants opening up over here, or people all of a sudden want to live in this part of town and they didn't 5 years ago. You know, you wouldn't drive over there 5 years ago, and now people are moving there. And so you start to get that gut feel. But that's not all, right? You can look at income demographics and you can say, hey, this is a low income area. But if you look at, and you can pull income demographic maps, you say, well, this area is low income, but everything surrounding it is high income. So this low income area is not going to be low income forever, right? Because people look for a deal. So they want to be near the high income area. And so they'll go there because you have better life outcomes if you live close to a high income area. So low income folks want to move there. So then it goes on. And there's a bunch of things like that where it's just helps you do site selection.
Right. It's a very smart way to think about that. It's like, I won't lie. I think I've read some of your work and I try to apply that to Oklahoma City as it's also trying to grow and explore. It's like saying, oh, wow. So let's think about like this. It could be an area. It's like, just try, like you said, just like look at the map and say, well, this place is high income. This place is high income. That place right now is not. So it sounds like something's inevitable to happen there, right? Like you were just saying. So that's the really smart way to think about that too. So someone asked in the chat, is like, what are the asset classes you guys are investing with QOZBs? And it's apartment complexes for the most part, right? Anything else that you'd like to dive into there?
No, we're only doing apartments. So we either buy old beat up buildings and we do gut renovations. So obviously with a 10-year hold, you're not just going to go in and change out the counters and cabinets. You want to go in and make a meaningful renovation. So we do the mechanical, electric, plumbing, the roof, the windows, the doors, the foundation. Like we do everything so that you're not waiting for the pipe inside the wall to break. You want to fix all that on the front end. So when we do a renovation, that's what we do. And then we're also developing new construction deals. In Texas specifically, on our new construction properties, we're using a structure called the PFC structure, where we make a deal with the local government. Local government wants affordable housing, and we as developers don't want to pay property taxes. That's the highest, most variable expense in Texas. And so we make a deal where we make 50% of our units affordable to people making 80% AMI. And in exchange, we don't pay property taxes for the next 60 years. So it's accretive to our returns. It meets the public benefit that the local government is set out to do. And it ends up being a win-win. And it's a perfect fit in these opportunity zones. So we're getting these federal tax benefits from the OZ structure, and we're also getting local property tax benefits.
Sounds like a match made in heaven right there, right?
Really
like
good.
No property taxes, and now it's bringing community. I guess, how much like brand new development are you doing versus like the gut renovations that you're doing? I guess it's like a 60-40 split. What's that kind of look like?
So of all of our OZ projects, it's been about 2/3 renovation, 1/3 new construction. But today we're only working on new construction projects. And that's just kind of what the market is serving up to us right now. I think very easily a year from now, it could be all renovation. It's just the way that the market works and the way that cycles go, and what we're able to acquire when.
Yeah, no, it's good to be fluid as well. And not lock yourself like, we're always going to try and have this kind of capital to have something like this where just how the market grows, we're going to grow with it. So that makes a lot of sense. So I want us to get to QOZ 2.0, but the first thing I want to ask is that, like, is there any lessons that you learned besides, like, obviously learning everything about QOZs, but like, is there any lessons that you can specifically point to that you learned working with QOZ 1.0? Anything that you've learned, any case studies that, like, hey, we would do that again, we would never do this again, anything like that that comes out, like, as you guys worked as developers and just like kind of through your raises as well?
I think we tried at one point to raise a totally blind fund, and that was hard to do. Just saying, hey, trust us, we're going to go do good deals. And that was hard. Right after that, we launched a fund where we said, hey, we're going to do good with your money, but here's the first 3 or 4 deals that we're going to do. And then we'll do some other deals that look like it. And that was much more successful. So I think that might be one lesson. But overall, I think the other thing is that we have a unique advantage in that we're both the fundraiser and the developer. So there's only one layer of fees versus a lot of other groups where they're charging the fund is charging a pref and promote, and then we are also. So that's another one. I'm not sure that there have been a lot of hard lessons learned other than there's a steep learning curve, and that compounds. So I've been out on podcasts and on Twitter and LinkedIn and everywhere else just teaching people. Yeah. And I think that's had a lot of benefit to it as well.
Has anyone been like, I know some people get a little antsy when you tell them, hey, you're going to be locked into this for 10 plus years, right? That you're going to be locked in for longer than what most people do. Any of your investors get antsiness when they hear that?
Certainly. I think the big thing that I like to talk about at that point is, yes, you are invested in real estate for 10 years, but that doesn't mean that your money is locked up for 10 years. So a big part of our business plan is we're going to go in and build real estate. Usually we're using 55 to 60% loan to cost construction loan with no preferred equity, no mezzanine debt, just plain old low leverage bank debt. And after we're done, we should have built something that's worth more than it costs to build. And then we're going to go get Fannie or Freddie or HUD debt on it, which will be a little bit higher leverage. And that allows us to send back refinance proceeds to our investors. So within a couple of years, we're going to send money back to our investors, hopefully a substantial amount. And then after that, we're going to send back regular rental income distributions to them on a quarterly basis. And then after 10 years, we're going to send the sales proceeds back to them. Yeah. And so that whole locked up for 10 years misconception is truly a misconception, because my goal is to send them back as much of their money as quick as possible.
Right. Yeah. It's like great way to remind everybody. It's like, hey, yeah, it's not just like you're stuck in, like your money's stuck here forever, you're just waiting for the depreciation. It's like there's a lot of other ways. And honestly, that's a rather rare deal structure nowadays that you hear about, right? It's like, we're just going to use old fashioned leverage, right? Not getting a bunch of bridge loans, mezzanine debt, et cetera, right? It's pretty rare to hear that, and not having, oh yeah, or this construction fee or this asset management fee. And then also there's this other fee that exists out there. So to me, that's like that's what I would look for personally from an investment as well. So,
well, it goes back to what we talked about a minute ago or at the beginning, which is like, look, the OZ is really the cherry on top, but to get it, you have to do a good deal, and not even a good deal. You just have to do like a base hit single, just a really basic deal. And the OZ will do a lot of heavy lifting. But if you start messing with mezz or pref or some exotic structure, you're going to screw it all up. So really plain vanilla real estate deals are all you're after.
Yeah, it actually makes tons of sense. And also creates stability for the community too, right? Which is also the goal. Like, which aligns with everything we're saying here, aligns with the intention and the point of QOZs. And like, it's a great, because now you're redeveloping a lot of these communities to attract more high income earners, to attract in more jobs, businesses, et cetera, which is the whole point, right? And so Congress's intent is playing out right there, which is amazing to see. Now, Congress has, and like, guys, this is where the real treat, like, not that Barrett hasn't been a treat so far. This is where a big part of the treat comes in now, because Barrett had a hand in helping craft the Qualified Opportunity Zones 2.0. He says a little bit, but I think it's probably a little bit more than that. But regardless, he helped with the QOZ 2.0. So to start, Barrett, while you were putting the pen to paper and writing out the legislation yourself, like maybe alongside Congress, maybe moving the pen for them, but What are the big differences between QOZ 1.0 and QOZ 2.0?
Yeah, let's start with the headline. Opportunity zone is now a permanent part of the tax code, which is enormous, right? Now everyone must pay attention. So opportunity zone in 2018 was cool. It is cool, but everybody didn't have to pay attention because it was a temporary thing that ends on December 31st, 2026 for all intents and purposes. Now it's permanent. Every 10 years, there will be a new map. In reality, you can truly have an OZ fund that lasts for 30 years. There's just a lot of things about permanence that mean wealth managers, RIAs, really big taxable retirement funds, all these groups must pay attention because this is a real tool in their investment tool belt. And so permanence changes the game for the opportunity zone fund structure.
Absolutely do. So permanency is massive. What are some of the other big key points to hit on when it comes to 1.0 versus 2.0?
Yeah, so we talked about the deferral earlier, but the deferral in OZ 1.0 was to a calendar date. So you deferred your initial capital gain until December 31st, 2026. So if you made an OZ investment in 2020, like my first investors did, then they got a 7-year deferral essentially. But I'm out raising OZ funds today and explaining to people, well, yeah, you get like a 1-year deferral. And that's all they get, which obviously is not very enticing to them. So OZ 2.0, which is all investors that come in after January 1st, 2027, they'll get a 5-year deferral on their tax bill. And anybody who comes in 2028, they'll get a 5-year deferral. And 2029, they get a 5-year deferral. So everybody's going to get a 5-year deferral in Opportunity Zone 2.0. It's much easier to explain. It's much more equitable. It's just going to be an easier thing to do.
Yeah, absolutely. Right now, yeah, you're not, like you mentioned, is that hey, it's right now, it's I have so many people who are yeah, I got a big gain. I'm okay, well, let's look at QOZs. By the way, you just kick the can down 1 year. And I go, I don't look, kicking the can down 1 year is still beneficial, which is a lot of tax planning that can be done, looking at whatnot, but it's just not as beneficial when you tell someone, hey, you get 5 years, right? You get a 5-year kick down the can. And so that's great. And then at 5 years as well, you get a 10% reduction in your tax bill, right? That's one of the other sweet benefits as well. What about the rural opportunity zones? What about those? And actually, can you dive into those a little bit too?
Yeah. So the rural part is interesting, especially with the definition of rural. This is one where we are waiting on some IRS or Treasury guidance on.
Yes.
Because the way that it seems like rural is defined in the code or in the legislation is very broad. In fact, most of the Opportunity Zone census tracts will be designated rural. It's any municipality that's 50,000 or less, or anything that's adjacent to them, which is everything. And so that's very interesting. And there's two big changes in a rural OZ census tract versus non-rural. And those two big changes are after 5 years, you get a 30% discount on your deferred tax bill. And the other one is if you're doing a specific type of deal, and this is going to lead us to another question, but if you're doing a specific type of deal, you don't have to improve the asset as much when you're working on it.
Right. All right. So speaking of the other question, what is this improvement test that actually we've avoided talking about so far? That's pretty key to QOZs. First, what is this substantial improvement that I'm sure everyone's heard about when it comes to QOZs? And then why do rural opportunity zones get a haircut when it comes to that?
There's 3 types of projects that you can do to qualify for the OZ tax benefits. So 2 of them are very easy and straightforward, and the third one people always get tripped up on. So the first 2 that are very easy, number 1, you can buy land and build a new building. Easy. You don't have to spend any certain amount of money. You can buy a piece of land for $10 million and build a $1 million building, and you're good to go. So that one's easy. Just develop something. The second one is called original use. So if you buy a building that's been vacant for a period of time, you're good to go. That period of time is currently 3 years. There's also a piece of legislation that says if it's been vacant for 1 year prior to being designated an opportunity zone, then that counts as well. So the new designations are going to happen December 31st, 2026. So if the building has been vacant for all of 2026, then it will qualify under original use. Just like development, you don't have to spend any particular amount of money. You just buy a building that's been vacant, you reopen it, and you've automatically qualified for the opportunity zone benefits. Number 3 is the substantial improvement. So if you buy an existing building that is not vacant, it's operating as, say, an apartment building or a warehouse or a hotel or any of those, in order to get the opportunity zone tax benefits, you must substantially improve it. What does that mean? Well, anyone who's familiar with historic tax credits is going to recognize this. It rhymes. So you have to first separate out the cost of the building from the cost of the land. So say you buy it for $5 million and the land is worth $2 million and the building is worth $3 million. Well, then you have to spend another $3 million. So your new basis is going to be $8 million in order to get the OZ tax benefits. So there's 2 questions there, which is number 1, what qualifies as an improvement? And the answer is anything you can get your CPA to agree to capitalize counts. So construction interest or attorney's fees or interim management costs, or there's all kinds of things other than just hard costs that can qualify to be capitalized. And then the second question is, how do you decide the $2 million land and the $3 million building? And that's another one where there's kind of 3 methods that the IRS has agreed with that they will accept. Number 1 is a ratio that the county tax assessor will give you. Number 2 is what an appraiser will tell you. And number 3 is another one that Nathan will tell you when you call him.
Yeah, so we went through tax roll, we went through appraisal, and then the other one would be like through to get the cost seg, right?
Cost seg, there you go.
Yeah. On that, so yeah, substantial improvement, right? It always feels very untouchable, but it really is not. It's very achievable to do. Now you got to make sure that you're working with someone who understands it to be able to achieve it. That's the key point there. And then what's interesting is that when it comes to rural activities, they cut down that 100% and put it at 50%. Right, to incentivize a little bit more going out into rural areas. Actually, there's something that I've been thinking about lately is that I'll be curious to see, right? I'm sure you know a little bit about where it's going to happen in Texas right now. I'll be curious to see what happens in other states, especially with the rural, with the opportunity for people to, with all the new AI centers, with all the crypto centers that are coming out there, at least that's like really populating Oklahoma itself. So I'll be curious to see what those tracts get established, because that would really, it's already being pushed out there to start doing those developments. Really feel like there'll be a lot more with that. I mean, do you think that could be a possibility with how it's currently set up?
Absolutely.
Yeah. So I'll be interested to see how that works out. I'm also kind of curious to see, sometimes it feels like, at least with the rural investment, is like having QOZs line up with the new qualified production property tax, like, because it's all about building new factories or vacant factories, which also aligns specifically with QOZs. And what a powerful tool where you get, basically, you can finally write off the entire building and then also defer all the gain and yet a step up on the basis when it sells in 10 years. Actually, also aligns specifically with QOZs with the 10, like another rule for qualified production property. Have you seen anything like that? Like, or any discussion from that on your side?
Yeah, I mean, the layering of those benefits is very, very interesting. And I think we will see a lot of it.
Yeah, it'll be interesting to see. I think I sent you this like a couple of weeks ago. There's like an executive order that was made, I think in April, talking about what, like, having some more like shipping docks or like beach or waterfront type properties being included. And someone making the assumption maybe that'll also get applied to QOZ 2.0s. What are your thoughts on that? I forget what the exact executive order is, but I didn't know since you live on Capitol Hill, Barrett. I wondered maybe you knew.
Yeah, it's the Maritime Production Act or something like that.
That's right.
Maritime.
That's it.
So it's actually the executive order is totally separate from opportunity zone. And this is now that OZ is permanent, I think you're going to see more of this, where the language from OZ is going to start to permeate other parts of the tax code.
Yeah.
And I think that's what's happened here is they're just saying, hey, we want to stimulate maritime production, whether that's through, private shipbuilding or more because of Navy activity or whatever it is. So that's what you're seeing there is this other piece of legislation is just going to pull in pieces of the OZ legislation because frankly, OZ is working really, really well. And so they're using that language in a totally different part of the code.
Right. No, I totally agree. It'll be interesting to see. I really feel like we'll probably in 5 years, we're talking super commonplace. Like QOZs were becoming commonplace already, but I think it would be even more so probably in like the next 5 years, right? So like, and I guess another question I had was, so I know we kind of have the blackout period, right? 2026. What are you guys doing to work around that right now with capital raising and like explain that to investors that, hey, we won't be able to use any of your dollars until this date, right? How are you doing that between like raising for current 1.0 projects and then what it's going to look like in 2.0?
Yeah, we will have an open fund, between now and kind of mid 26. We expect fundraising to be good, for the next several months and then taper off significantly through early 26 and then pretty much stop in mid 26. We will have started fundraising already at the beginning of 26 for our 27 OZ fund. And we will be fundraising for the last 9 months of 2026 for our 2027 OZ fund, which we'll call capital in January of 27. And that will be for people who have a partnership gain in 27 or who have a stock or crypto or any other type of gain in the back half of 26. And, I think someone would be irrational to recognize a gain in the back half of 26 and invest it into an OZ 1.0 fund.
Right. Yeah, I would agree with you on that. It feels like it's like the way it's just structured that like it feels like most people are probably going to go into 2027 funds. So it makes sense. The other thing I was going to ask was when it comes to the 2027 projects, what are you guys like? So I'm sure that you have, since you're on Capitol Hill and you've some involvement locally as well, what are some like things that do you potentially know where the new census tracts are going to be? Have you heard some preliminary figures or zones that might be designated? And I guess, are you guys going to capitalize on that? Is it going to be beneficial?
So you're asking the right question. The list of eligible census tracts has been published. It's still early, though. It's still a guess. So the list that's been published today is based on 2024 census data.
Gotcha.
There will be a new list published on 2025 census data, and that's what they'll actually be chosen on. Okay. But we roughly know what census tracts are eligible based on the median family income and based on the poverty data. And so we know where roughly the pool of census tracts that could be chosen from. And then each state's governor will decide which of those they actually want to designate. Some states, it's very easy. I think it's Vermont has 25 eligible census tracts, and they only are allowed to designate 25. So that's it, right? Like Vermont knows where the OZ census tracts will be. Texas, which I know a lot about, is going to be much harder. There's like 2,500 eligible census tracts, and they can only designate 850. So like a third of the eligible tracts will be designated. That task is going to ultimately go to the governor, but he's pushed it down to the Economic Development Office. So there's a few people in the Economic Development Office who will make those decisions. There's going to be a lot of lobbying from county officials, city officials, developers, investors, to try and say, hey, you've got 2,500 choices to make, but only 850 of them are actually going to be designated. And here's why I really think you should make this decision.
Yeah, it's going to be a lot of lobbying, right? It's going to be a ton of lobbying between now and in that publishing time frame, just across all the states, right? Anyone who wants to like begin incentivization or see certain areas get developed, right? And so, and you know what? That's part of it, and that's part of it, and that's okay. It'll just be interesting to see where those places get thrown out, right? So, like, I know there's been some bad publicity of when the original tracts were released for OZ 1.0. So hopefully that like this time there can be a little bit less so on that front.
I think some states did it very well, very intentionally in 2018, but most of the states didn't understand the importance of the OZ tax benefit and didn't think a whole lot about it back then. I think this time they will. So I'm hopeful that most states will get it right.
I agree. I agree with you, Barrett. So Barrett, we've got one person asked a question. Karen, she said, to create a OZ fund and then invest in OZ property, you need capital gains. What if you need to invest in a place that is 1 million, but only have capital gains equal to the down payment? Can you finance the rest of the purchase price, or does the entire investment come from capital gains? That's the first part of the question.
You can absolutely use debt, just like any other real estate investment.
Right, absolutely. Also, if the significant improvement, does that also have to come from capital gains, or can I get a construction loan? The answer is yeah, no problem. We can absolutely but you can absolutely get a construction loan for that piece. You don't have to use capital gains again. It's just your initial investment, right? Yep. Barrett, you probably hear a lot of misinformation when it comes to QOZs, and you probably get people all the time asking you, saying, "Hey, I own a property in a QOZ, right? What can I do here?" What's the unfortunate answer that you have to give them?
Yeah, there's related party rules that prohibit you from kind of doing it yourself. If you work with a really good tax attorney, they can talk you through some ways to like lease it to another entity. And, there's some quirky workarounds that you can try. That goes back to what I said at the beginning, which is like spirit of the law, letter of the law, what we're willing to do with investor money. But if you want to be a gamer with your own money, go for it.
Yeah, right. Yeah. So that's, it can be a little, it's not the easiest in the world. And then Rick asks, do all states recognize OZ capital gain tax benefits? And I don't think all states recognize that, right? I don't think many, if any, recognize it or conform to what the federal does there.
No, you'd be surprised actually. But the big ones that you would expect not to do not. So California, New York, they don't play ball. Of course. But there are others that actually really are behind the program. I'm trying to think off the top of my head, but like does Ohio have a state income tax? Arkansas. There's a few that have really gotten behind it and said, not only do we recognize the program, but also they've thrown additional benefits behind it and have some state tax credits if you utilize the program. So some have really bought in.
That's great. I did not know that. What are some states outside of Texas? I know Texas is where you do most of your work. What states have surprised you when it comes to like that they've actually done a really good job with OZs? You've seen other developers have similar successes as you guys out there.
I've made friends with developers that are very active in Florida, Arizona, North Carolina, Montana, all over the country, really.
That's great. No, that's great to hear. One other question someone dropped in. QOZ funds can only defer capital gain tax, not on depreciation and recapture from selling highly appreciated and depreciated real estate. Is that right? The answer is correct. Yeah, you can't use 1245 and 1250 depreciation and recapture into a QOZ. You can use unrecaptured 1250. So it depends a little bit on the situation, right, Barrett? Am I saying that correctly?
I'm glad I didn't get that question.
The answer is yes. I believe the answer is correct. We cannot defer depreciation and recapture unless it's unrecaptured 1250. It's a totally weird subsect of the code, but that's potentially possible. Barrett, thanks so much for coming on today. I really appreciate it. This is my personal treat getting to talk to you about this today. So I'm super glad to have you on. Everyone, if you have any interest in learning more about QOZs and just like seeing like the amazing stuff that Barrett and his team's always doing, go give him a follow on LinkedIn, X. What are other places, Barrett, people can find you, Barrett?
That's where I'm active, and I've done a bunch of podcasts as well. So you can find me on any of those, YouTube or Spotify, doing other podcasts as well.
Barrett had an amazing podcast with Chris Powers, if you guys know that name in real estate, a couple weeks ago. Maybe it's longer than that. I'm not sure at this point. That's how I listened to it. It was an amazing podcast, so I recommend giving that a listen as well, everybody.